Hello and welcome back to the Note. Well, August is in the books and many people will be very glad to see it go. The worst month for world stock markets since 2011, even if that was much alleviated by the rebound at the end of last week. Now, over the weekend we had the Jackson Hole meeting by the Fed. We had largely more hawkish noise out of Jackson Hole suggesting that a rate rise next month is still a possibility, and as a result you had a poor day for US stocks today, and that created the dreaded death cross in the S&P 500. For those uninitiated in technical analysis, that's what you call it when the current price of the S&P drops below its 50-day moving average, a measure of its short-term trends, which in turn drops below its 200-day moving average. Now, this is the first time this has happened since 2011. Death crosses, generally speaking, do presage at the very least quite a significant sell-off, and they often presage bear markets. People should not trade solely on the basis of any kind of technical indicator such as this, but many people do look at this. It does matter. It could have an effect. If we move on though to oil, which is obviously at the center of the sell-off in equities of late, you can see that we've seen a quite remarkable rebound in the last few days. From the very bottom intraday last week to the top today, the WTI contract actually managed to rebound some 30%. Although, as you can see, the sell-off had been so steep that that still doesn't alter its ongoing downward trend. As I understand it, this is largely because data on supply here in the US has turned out to be much better than expected, i.e. the producers are cutting back supply more than thought. That caught out many people who had been short, and you have a short covering rally. Those who had bet on oil to go down have been caught out. It still doesn't add up, however, to an emphatic reversal of the trend, despite the fact that somebody somewhere has made a lot of money in oil in the last week. Now, where do we go from here? Well, obviously, we have a lot of very important data before this week is out. ISM's tomorrow, US unemployment data on Friday, possibly the single most important data to face the Fed before they make their decision. If you look at corporate earnings, though, you get a very interesting picture. This is data from Thomson Reuters. It shows you yearly earnings growth quarter by quarter since the beginning of last year, actual numbers earlier on, predicted numbers for 2016. And you can see that if you exclude energy, earnings growth really has been very positive for the S&P. This leaves you with the option of hoping that once energy prices rebound, we're going to have what looks like a very healthy US stock market, a very healthy US corporate sector. Against that, however, let's now take a look at two specific sectors, materials and industrials, the two that are most obviously affected by a Chinese slowdown. And you can see that we are now looking at outright declines in this quarter and for a very sluggish recovery thereafter. People at this moment are spooked by China, and the results that have actually come in so far suggest that China is having an effect. If the Chinese economy slows down to the worst end of expectations, that is still a very worrying prognosis for the US.